I'm always interested in the market. The market's been rather unfriendly the first 5 weeks of this month. We talked about this morning with Tim Marshall and Dr. Heiss, and I guess the things that came out of that, at least in my frame, was one is oil, two is China, and three, maybe you throw it into the mix, is migration coming into Europe in particular. And I'm wondering if I can turn it over to Rob, how you think these views will impact real estate, and how should the industry respond to this weighty question?
That's a big question. I'm Rob Coaches with the Townsend Group. Happy to be here in Paris with everybody. My firm, just to give you a little bit of background, my firm works with about 100 institutional investors around the globe. Most of our clients are public pension funds, again, around the globe. Our typical client is a U.S. public pension fund. But in total, we advise them on their real estate and other real assets portfolios. And in total, they allocate and invest about $170 billion to real estate around the world. Having said all that, I have no answer to Roger's question. I mean, there are so many facets to the real estate market and the investment opportunities we see. We don't claim to be able to predict such trends in the future. But what we do with our clients is we use real estate and some of these other hard asset classes as a great diversifier in their investment portfolios. You know, these are multi-asset class investors typically that have maybe 10 to 15% of their portfolio in hard assets like real estate. And most of them view that as a diversifier. They view it as a store of wealth. And they look to real estate to more or less prop up and hold up their portfolio, to be kind of that safety net when you have times like we've had so far this year with the volatility in the stock market and plummeting commodity prices, et cetera. I think by and large, we've had a nice run in real estate. I'm an American. I know the U.S. markets best, and you know, we've completely come through the recovery from the global financial crisis in the U.S., and we've kind of entered the growth or expansion phase of the economic cycle, and that calls for a little bit of a different investment style. But our clients are still looking around the globe for for recovery and distress, having trouble finding it in Europe. And we're struggling, most of our domestic clients are struggling with currency issues today because the strength of the dollar, while it can be a benefit for those investing new money, most of our clients have suffered 15 to 20% losses in their investment values when you translate those investments back to US dollars. So they're very cautious and very keen on currency issues right now. So we're getting a lot of heightened evaluation of the currency impact on our investments today, both historical as well as prospective.
Well, let me ask the question a different way and direct it to Anthony. Will you guys in Europe think you'll be a net buyer or a net seller in 2016?
I think we'll probably be both. If we look back at where we
All right, next. No, just kidding.
Seriously, I think if you look at 2011 through 2015, we were clearly a net buyer here in Europe. Probably 14 and 15, we were a little bit of a net seller in the US. Today, I think we've sort of reached an equilibrium where you can look at some situations and say you can find attractive opportunities, but you can also look at the markets, certainly for stabilized assets, and say it's a good time to be selling. So I think we'll be doing both of those. The geopolitical question that you asked, I think from our perspective, is the one thing that we are a little bit concerned about. Very difficult to know exactly what the geopolitical impacts are going to be, particularly the unknowns. You've described the knowns, which is the oil and the migrant issue. But I mean, we look at Brexit and a little bit concerned about that. We look at some of the political movements going on across Europe, some of the polarization both to the left in places like Spain or to the right in other countries, Poland, perhaps even some of the recent provincial elections here in France. All of those have more of an impact in European investments than perhaps they do equivalently in the US, where you can have a relatively dysfunctional Washington, D.C., and still have the economy powering ahead 2 to 3%. It's more impactful in Europe, what happens in the geopolitical arena.
Thank you. Isabel, you care to add to that, or on to the next question?
So the question about the challenge.
Do you, in terms of the global, the macro, or so maybe Europe, how does AXA think about it as an investor in Europe?
I think we are probably mid-late cycle. But if we look at the fundamentals for real estate, there is no debt oversupply, which is very different than the previous cycle. We are also facing no oversupply, so the fundamentals are quite good. So definitely, the main risk for us is to see at the end a shock in demand. It should not be big, because if you look at the fundamentals, the oil price, the euro, at least for Europe, the euro value, this should support the growth, and so we should be in front of some growth in Europe. So globally, the picture is quite good, and the fundamentals are not bad. So for sure, it's true that the geopolitical risk may have an impact, and we of course look at that. And if we look at the performance of the shopping center in France, they have been significantly impacted in December by what happened in November. So this can have a hopefully short-term impact, but globally the picture is not too bad, at least for Europe, and so we should be a net buyer next year.
Thank you. Maybe move on to my next question. I want to talk a little bit about capital flows and the business environment. Many of you know ULI creates something called the Emerging Trends in Real Estate, which was just launched. And I think the outcomes generally for people saw from 2016, there was a positive sentiment, but there was a stronger undercurrent of caution than last year, with capital flows still being dominant factor in real estate investment. I'd like to turn it to Chris to talk a bit about what do you see happening in 2016 with respect to global capital flows?
As far as we're concerned, there's been huge capital flows, which is, represents huge competition for us as an investor, and we don't see that stopping. But clearly the geopolitical risks and the oil price is having an impact on some people's abilities to invest at the present time, and it's creating uncertainty. So just some anecdotal hearings that apparently sort of in late 2015, people were looking at things like break clauses or lease termination events as opportunities. Since the turn of the year, people are now looking at those as threats. That will mean that they're being much more cautious about deploying capital. So that, I would think, will mean that perhaps capital flows are going to slow down a little bit. Clearly, you've got the impact of the oil prices in the Middle East, and we're hearing that some of the big sovereign Middle Eastern investors are maybe having their purses closed for the time being. So again, that's been another big source of capital, which is going to slow down. But there's so much capital in the world, which is largely funded by quantitative easing and the cost of capital, that really I don't think there's going to be any shortage of capital looking for a home in the real estate market. So I think that the direction of or where the capital comes from may change, but I don't think it's going to ease up.
I've always thought of sovereigns, unlike my business, which is a limited life business. You have a fund, its life is 7 years, maybe you extend for a year. You have the ability to look past turmoil in some ways, because I think of you as someone who can, unlimited life, you can plant your flag in Paris and look past November, which is horrible, and say, okay, well, maybe that's not only a good time to invest, but irrespective of migration, Paris has been around for thousands of years, it's going to continue to be around, and this is a good time. Do you think in those terms, much longer term, do you think, is that an advantage for your capital?
Oh, absolutely. I mean, I firmly believe that that's one of the advantages we have. We don't have any liabilities, so we're truly long-term investor. We think in terms of 20-year time spans for our returns, although that doesn't mean we simply buy assets and hold them for 20 years. We're actually very performance focused, and we're looking at the outlook for our returns each year. But insofar as pricing adjusts, we are less worried about short-term risk because we believe we've got the ability to hold through the cycle, or we don't have any financing risks. We can just hold for the long term, and we believe. So it goes back to the fundamentals of the markets, and if we see the pricing adjust to an attractive basis in markets which are fundamentally strong, that becomes a great buying opportunity for us. But if we think that pricing is high, and certainly at the moment yields are very low, regardless of the fundamentals, we may not be so active. So, but there's always something to be done somewhere. I mean, GIC is a global investor, and so one of the opportunities of sort of going to your point, Roger, of having a long-term perspective is that we can try to be counter-cyclical, because we're not measured on short-term performance. So the best time to invest is when pricing is low, and that is typically, when the market's on their knees, which in some ways is the most difficult time to have the confidence to invest. But we're currently investing quite a lot in Brazil, for example, which is certainly a market that's on its knees, but pricing opportunity is more attractive down there. And time will tell whether we're getting that right, and more importantly, how long we have to wait to get it right. But we do think that it will turn the corner and will come good. What we try to avoid, and I guess we're trying to avoid in Europe, is sort of the herd mentality where everybody's piling in and investing at high pricing, because in our experience, that's when you don't necessarily get your best returns.
Thank you. And Rob, you mentioned currency earlier, and you represent American capital to a large measure, not exclusively, but isn't it a paradox that when I think about the dollar, it's compared to the euro may have been 87 centimes at one point, got as high as 165. It's now bouncing around at 110. And Americans are saying maybe they shouldn't be in Europe, when in fact, if I'm right about that scale, it's probably not a bad time to be investing more here.
Well, yeah, I mean, the contrarian would say that revert to the norm, and it would be a good time to invest. But one good thing is we've had a good run of opportunities in Europe, and so as I talk about our U.S. investors, they're not going to be more than 20 to 30% of their portfolio overseas. Typically, most of their investments are in the United States. And then when you talk about Europe versus Asia versus emerging markets, maybe it's only 5 to 10% of their real estate is in Europe. And we've had a good run of capital raised in the U.S. specifically for investment in in Europe. So our clients are pretty well exposed to these markets already with strategies that are underway, and it's been a pretty active 2 or 3 years now. We track all of the private equity real estate funds that are raised and offered to our clients. It's typically about 250 fund offerings a year, about $50 to $75 billion a year raised. And we saw a market increase in kind of European targeted funds in 2013 and 2014, and that dropped off pretty quickly in 2015. I think a lot of that has to do with currency. I think our clients feel a little bit burned, and they're not so much willing to make those specific bets on overseas markets, but what they're doing is they're giving their capital to large global allocators such as Apollo and Blackstone, and letting you decide where's the best place to go, and try to manage that currency risk.
And Anthony, if you had to choose within countries for 2016, all other things being equal, which of course they never are, but what countries does Blackstone like in the next years?
Well, we're pretty active across the globe, but I think in part our strategies do change with the changing backdrop. In the U.S., I think most interesting right now for us has been what we've seen in terms of the repricing in the public markets. And so over the last, I would say, 6 months, we've seen some good opportunities to, in effect, take advantage of what has been a fairly dramatic repricing in the public markets, which we think in some respects has overreacted, or certainly the public markets are looking ahead, seeing a fairly dramatic decline in future cash flows. And we've been able to take actually 4 companies private, 2 in the US and 1 actually in the UK. I would say in Europe, we're still probably more active in places like Southern Europe, which still have remaining, lingering distress and dislocation. And I think, we still look at Europe in general and always have looked at it as sort of a moderate growing environment without much reliance on growth to get you much of your returns. So for us, it is about the situations that we can create to establish an attractive basis in what we look to acquire here. And the sort of value proposition seemingly is probably as great as it is in Southern Europe today. The big 3, UK, France, and Germany, certainly capital values have risen back to perhaps where they were in 06, 07, if not slightly above. So it becomes very situational there. And then some of the more macro themes, like logistics, which have good tailwinds. And in Asia, I would say we've been actually very active in India. China still is growing, but obviously the rate of growth is slowing a little bit, whereas India is growing, and actually their rate of growth may actually exceed that in China. So we've been very active as buyers of office properties and retail properties in India, which does not come without its risk, but from our perspective is being priced very attractively.
Isabel, you represent capital that invests in debt, creates debt opportunities. It's in core plus, it's in value add. When you think about what you want to do, where you want to deploy capital, both within the capital structure, where do you think you'll place bets in this year?
So what we continue to do is definitely to have a holistic approach to real estate. So we look at the 4 quadrants, direct real estate, and for direct real estate, we really focus on cities, at least for offices. But we are also growing our debt platform, and now it's close to 11 billion. We integrate more and more public listed instrument into our allocation. It's a way for us to play with liquidity and also volatility. So we balance the 4 quadrants depending on our client constraints, and also it's a way to monitor the cycle and to have different play depending on the various cycles around the world. It's also a way to integrate listed properties to speed our globalization and to get access notably to the US market. So yes, we are looking at the 4 quadrants. We continue to grow our debt platforms. There is still the value here, but more and more we try to globalize it and to include listed instruments into it, as well as we do for equities.
So one of the questions for the panel, from my perspective, is when I look at Paris and London, they attract by far more capital than any other places in Europe. And yet, when I look outside my window in Mayfair and read about the most recent shop sold, for a 2% yield, it feels like things are really pricey. And I'm just wondering, who's right in your opinion? Is London sort of overvalued or Paris overvalued today, or do you think there's still room to run? Certainly the capital is still voting to invest there. Anthony.
I think you have to also look at what the ultimate goal is in terms of the investor making that commitment. And liquidity is clearly a very important factor for a lot of investors. And there is no market that's more liquid than London, for instance, and probably followed by that you have Paris. So on the margin, a number of investors that are investing in these markets today are investing because of the push from diversification, or looking for a safe haven, in which case the ultimate economic return is perhaps not as important as it might be for an investor like you or I, but the liquidity aspect and the fact that they can sleep at night is very important. I do think that the residential that you mentioned in the UK, for now, clearly, sentiment has changed, and sentiment drives the residential market, and in turn leaks into the rest of the overall market. So you're also seeing, I think, on the margin that sort of the marginal investor that might have come out of Asia, or the Middle East investor who has perhaps less access to capital today, there's going to be fewer of those investors. So the depth of the market will reduce somewhat, certainly on the commercial side. But clearly on the residential side, I think you're seeing a real pullback, and it may be that we will see a repricing in London, shortly.
Isabel, you care to comment on Paris?
No, I think Paris, if growth is there, it will remain an attractive market and an interesting market. And I prefer to buy in Paris than compromising and going into the regions where spreads are not so capital. Rates are not so attractive. So yes, Paris is more interesting. It is. If you are in the right location, you will always find a solution, and you will be capable to go over the cycle. And if you look at the cap rate in Paris, they still offer a good premium, also on an historical basis compared to the govies. So for sure, cap rates are quite low, but if you go, everything being equal, if you look at what you get on the bond market, it still offers a good value. So what we like to do, and what is I think is also interesting for Paris, is to consider also refurbishment, redevelopment. A big part of the Paris stock is quite obsolete. There is not so much supply in front of us, so there is also a good, interesting things to do, at least for the office market, considering refurbishment or pure development in Paris.
Thank you.
Roger, I'll just add to the question. I mean, I think there's some simple reasons why London and Paris are the biggest investment volumes, which is the values are highest and the lot sizes are biggest. And there's more big deals done in those markets, partly for those reasons. And if you're a big international investor coming to Europe, they're the easiest markets to go into. So your first port of call is likely to be London. It's very easy to transact in London and not so difficult in Paris. So I think the question is, are the returns, maybe there's less risk there, I'm not sure that there is, but are you going to get rewarded for that? And then can you find suitable opportunities in other markets? I think once you've been in Europe for quite a long time, you say, yes, there are. That's not to say there isn't money to be made from investing in the other European markets, and Anthony's group does it extremely well. So, but I think that, as a first port of call, London and Paris are the easiest markets.
And how do you, so Isabel, you referred, and Chris said, this is maybe a corollary of your comment. So the 10-year bund is whatever, it's 50 basis points or 60 basis points. And I don't know what the 10-year gilt is, but let's say it's, 1%. I mean, it's extraordinary in relative terms. And then you sit around and debate in your committees and say, well, where do you put money? Government of Singapore is unleveraged. You've got a huge fund. And do you invest, and either it's cash or it's bonds or it's stocks or it's real estate. And I know you're focused on real estate, but when you look at it in those terms and you look at London or Paris trading at 2 or 3% in some instances, not for all asset classes, but I mean, how do you think about it? Do you sit on the sidelines and wait if you're looking at something that would be on equivalent yield basis at market? If you were offered something in Bond Street at 3%, or would that be something potentially, Chris, that would be attractive to you?
Okay. So having said that the benefit of having a long-term horizon is you can think long-term, one of the challenges is that we are actually measured, or our returns are measured over long periods, and therefore, and that to some extent they're compared against bond forecasts over long periods of time. So it's all very well going in at low rates of return today, but if you think that they're going to, the bond yields are going to increase over long periods of time, then you're going to underperform over those longer periods of time if you get your pricing wrong today. So we are cautious about that, but I guess what do? Well, we focus very much on the cash flows, because one thing's for certain: if you've got cash in your pocket, it's, it doesn't burn a hole. Whereas if you haven't, then it tends to be a much more risky situation. And yeah, I guess long term we're still quite focused on what is the likely required rate of return over long periods of time, rather than
Right.
for today. So it's less about, as Anthony's talking about, some people that are looking for a safe haven for their capital. I think that's a different objective to perhaps some of the sovereign wealth funds who are looking for long-term growth generation. Some might have that objective.
So how do you think about that? So, yields are very low in the major capital cities, not just in the two I mentioned, but German yields in Berlin or certainly in Munich are quite low. But I'm from a small town from the Midwest, and these small towns don't dry up and blow away. They may not have the growth, in Manchester or in Leeds or in Lyon. But when you think about investing there, Anthony, do you look at that and to Chris's point, you say, okay, well, if I can get 300 or 400 basis points more of cash, that's a substitute for growth, and I'll make a bet in that market, despite our conference focusing on density and people moving into urbanization, and maybe that's better longer term.
Not really, actually.
Okay.
I would say we are increasingly focused on the global urbanization trends and increasingly focused on the major gateway cities. Our experience in drifting, what we would say, into more of these smaller secondary, tertiary cities has not been great over time, and it's sort of it's a false attraction in our minds to go for those higher yields. Because ultimately, if things were to turn down, certainly there's less liquidity. There's less liquidity to begin with, and certainly that gets exacerbated. But we just think that, there are, whether you take London or New York or Hong Kong, global cities that are really emerging and differentiating themselves from the rest, really attracting a well-educated labor pool, the brightest and the best from around, whether it's Europe or around the world. That attracts employers who are looking to employ those folks. And they're ultimately differentiating themselves longer term and separating themselves in terms of their success. And we are strong believers, to the extent possible, in focusing on those cities. Same thing if we're investing, in the Netherlands. As much as possible, we want to focus either on Amsterdam or the Randstad, Paris pretty much only in France, et cetera, et cetera. So for us, we would actually rather take the lower yield for the higher growth. And we don't focus as much on going in yield, because a lot of what we buy is either vacant or needs to be fixed. And it's really about the metrics of what you're paying per square meter and how much value you can add. So for us, it's always better to be in a better location with a better quality asset than a high yielding asset in a secondary location.
Okay. Now, one final question from me, and then I'll open it up to questions, which is, we spent part of the conference talking about density as one of the major themes of now and next year's, but there's others. I mean, there's technology, there's e-commerce, there's all sorts of things that are changing our environment and how me and certainly my kids are going to work and shop. And I'm just interested to know from the panel, and this is an answer or question for any of you, are there asset classes that you really like on the back of what I've just said? If you project out for 10 years, are there asset classes that you really don't like because you think in 10 years' time everyone's going to be shopping from a computer as opposed to shopping in a mall? Anthony, maybe start with you, put you on the spot.
I'll give you the easy answer from our perspective, which is with respect to sort of e-commerce and the macro trends, the fundamentals around that. We see it long term as really one of the strongest tailwinds for modern logistics. The flip side of that, obviously, is the impact on retail, and particularly secondary retail. But we've been big believers all over the globe that this is an inexorable trend upwards, for the most part, only over the foreseeable 5 or 10 years, where the penetration of e-commerce retailing is going up, and the requirement from those e-retailers is for additional logistics. I would say the other part, just to throw into the mix, is something like Airbnb and its impact on hotels. We're not clear yet exactly what that impact is going to be, but certainly in cities like Paris, which gets a lot of tourism, you can see it having an impact, particularly on weekend, and particularly on the ability for hotels in the tight periods to raise rates, because the overflow is that now people have an option to go to Airbnb. So we're watching that. It's a sort of disintermediation like Uber has been for taxis. This is something for us in the hotel industry to consider.
Thank you. Anyone else care to take that question on?
I have to say, it's a little humorous for me being an American to talk about density here in Europe, because we invented the suburb and sprawl, and a lot of planners in the U.S. emulate the density that you already have in Europe. But having said that, we see a couple of things which don't quite apply to Europe as they do in the U.S., but the trend towards urbanization is real, and it's all over the world. And our clients have been very active in mixed-use developments and redevelopments. We have a trend in the U.S. With a growing younger population, the millennials, so to speak, that have a lot of different lifestyle choices when it comes to housing and retailing, et cetera, which is perhaps not as big of an issue for you here in Europe as we have there. But having said all that, I think the whole focus on lifestyle, quality of life, and creating an environment that we've been talking about at this conference is real, and we see that as a theme underlying a lot of the investments that we make and that our clients make, including even in London and Paris today.
Thank you.
And I'll just
Chris?
add to that. I mean, historically, we've all had a tendency to separate uses. So us, particularly in Europe, we've separated offices from retail, from living. And from an investment perspective, we think that's been a benefit. If you go to Asia, which is certainly a very dense population mass, you see much more mixed-use developments. It's very common to have a shopping center with two big office towers on top of it, with a hotel tower, maybe with a residential block nearby. And typically it's the residential that's used to finance the project. And people can either invest in the whole project or they invest in parts of those projects. My own feeling, and this isn't a GIC sort of view necessarily, is that densification, urbanization is going to require us to get much more used to mixed use. It's what the younger generation want. They don't want to go to office environments which are just sterile, and when you leave, the lights go off, there's no bars to go to, there's no restaurant, there's no life. And that's what the City of London used to be. But now that we've got shops coming in, we've got bars coming in, we've been a big investor, courtesy of Blackstone. We bought their half interest in Broadgate. And we're trying to make Broadgate a much more appealing office environment, just as King's Cross has become, for those of you who've been to the King's Cross development in London. I think that's a fantastically vibrant environment now, and I think it's leading the way that we need to think about densification and mixed use and making these places exciting to be. It's mixing offices with retail, with residential, with leisure, the whole thing together.
Right.
So.
Isabel?
No, I agree with what has been said, and notably regarding density, offices, and the big cities. Definitely for offices, what matters is cities more than countries. But there is one theme that we also like is alternative, and notably healthcare, especially for Europe. We are definitely lagging the US market, which is a far more mature market, established market. And what we like in this environment of uncertainty is the fundamental growth attached to this asset class. So it's definitely something we are looking at. Logistics is of course also something of interest because of the structural shift in the retail sector.
Thank you. We have time for a few questions, and this has been fascinating, but I want to open it up to those of you in the room and see what questions you might have for this panel. Don't be shy. Yes. Do we have mics? Here we go.
Hi, Alexander Laborte. So since we're talking about trends, Isabelle mentioned aging population, so healthcare. I know student housing is now a trendy subject. Chris, I know GIC has invested in student housing, so maybe the panel could say something about this possibly emerging asset class within real estate.
Okay, student housing. Maybe start with Chris. The question was directed at, and others on the panel who may have some expertise.
Okay, so we first invested in student housing in the early 2000s, when it wasn't really an institutional asset class, and we were getting very attractive yields, 9-10% yields. And we helped a company called Unite to build up we financed their development program. Unfortunately, we held those assets, and we now have a subsequent venture with them, which is very focused on students in London. I think one of the issues with student housing is the cultural aspect of where do students stay. And one of the things we're grappling with as we consider the opportunity in Europe, and it'd be interesting, other people maybe I'd help me on this, is that I think it's quite common for students to stay, not travel for university and maybe stay at home. So is there the same demand in different cities around the world, or sorry, around Europe, as there is in London? London benefits from a lot of international students, and the sort of student accommodation that Unite are providing is not cheap, but it provides a very good solution for international students coming in, that they can be guaranteed of their it's good quality, safe, they've got internet connections, etc., etc. But I would think, I haven't got the stats on my fingertips, that the high percentage of the population are foreign students staying in that sort of accommodation. So really the question is, what's the market, and what's the local market like? We had the experience, again, going back at the same sort of time, we invested in senior living, and we invested in a vehicle which invested both in the UK and in Germany. And fortunately for us, we put more money into the UK, where it did extremely well. It was funded by the equity that people had been fortunate enough to enjoy in the growth of their housing over time, and people were prepared to pay for that. In Germany, it was a completely different model, and it was, I have to say, a very unsuccessful investment, because culturally it wasn't the same. At that time, it may have changed, but it wasn't the same demand, and possibly because people didn't have the same equity in their homes, or there's more of a culture of renting in Germany. So the dynamics were quite different. So I think it's very difficult or you can't just assume that what's going to work in one jurisdiction is transportable across all jurisdictions. You've got to look at the local dynamics.
Thank you. There's a question over here.
Yes, it's a question to the panel. Given all what has been said all day, to which extent do the people at the panel think the European economy is moving into some sort of Japanization of it? And if yes, what do you plan doing about it? I mean, Chris Morris and Anthony Myers have partly addressed that question in terms of what they plan on doing about this. But generally speaking, I'd love to have the other members of the panel answering that.
Okay, thanks. So I think the question is, how do you invest in what may be a deflationary next 20 years in Europe? How do you think about that when you make investments?
Yeah, it's, as I said earlier, I think we've always had the perspective that Europe, in any event, is a low-growth environment, and perhaps you're referring to an even lower growth deflationary environment. I would say that our sense of Europe today is actually, it's doing a little bit better than it was, say, in the past 12 months, or 2015. It did moderately better than in 2014. Some of that has to do probably with the currency, and some of it has to do with the oil price, and that's likely to continue, and rates are likely to stay low in Europe. And so we actually think that 2016, and I think we heard this in the earlier panel today, we tend to agree that growth here will be sort of moderately accelerating, still below 2% growth, but in a European context still pretty attractive. And of course it's very different across the various jurisdictions. We don't generally underwrite much in the way of growth, or much in the way of indexation, or much in the way of rental growth in many different locations. And for us it's really about establishing an attractive basis in an asset, and finding ways to add value through your asset management, and less about growth or relying on the overall economy to get you your returns.
Okay, reassuringly, hopefully no Japan. Jürgen, I think you have a question.
Yeah, a question about Germany. Germany seemed to be the hot market for 2016. It's also looking at the emergent trends, ULI, PwC, with Berlin and other cities coming right after the number one to be. So what is your view on Germany, and is it not to be overpriced already?
Who wants to take that? One of the experts. Isabella.
I'll say.
Oh, Robbie, you're going to.
I'll just volunteer and say that from our perspective, I think our clients cycled out of London and Paris a year ago, and we've spent quite a bit of time looking for opportunities in Germany. There's a lot of interest there. Like the growth prospects there, better than some other countries in Europe. The controversy created by the wave of immigration and everything, I think, is a real issue, though, for our clients, and it causes them to pull back a little bit and show some caution. But the strategies that our clients have been looking at are, assets that are being sold by institutions that have held them for a long time, maybe not managed them very well, so there's some opportunity to either buy at a better price or at least improve the management and improve the income performance, and then hence the sale ultimately. That's more or less what we're looking for, is more of a value add type, undermanaged, maybe poorly capitalized properties.
Thank you. So one final question.
Technology,
Right.
big
Nice.
data, and these kind of things in real estate, what impact does it have on capital markets from an investor perspective?
Well, I think we feel we sort of answered that, but maybe there's other answers. Do you think, for one I guess hypothetical would be in London, there's shortage, the phenomena that's going on with the tech market. I mean, they used to talk about Reading to some extent. South of France, I think. Berlin, to me, is another market that's exciting in terms of tech. And would you choose those markets perhaps for growth over other markets in Europe?
No, I would agree with you, Roger. Those two sub-markets are both, or Berlin City and Shoreditch, just north of the city of London, clearly an emerging market that's benefiting from the growth in the technology tenants. The shared office space is another trend, I would say, that's driven in part by technology. I mentioned Airbnb, but I'm not sure if the question is related to the fundamental demand created by technology-type tenants or technology itself on the capital markets, the function of the capital markets, which it may be referring to crowdfunding, ways to raise capital, et cetera, et cetera. We've had that question actually come up before. I'm not sure. I think Rob would be best probably suited to talk about fundraising and whether crowdfunding is taken away from the
Rob,
ability.
you've got 30 seconds to answer that. And it better be the right answer.
Yeah, we've heard a lot about it. We haven't really seen it in action where it's impacted our investment activity at all in the U.S. or in Europe. So.
Okay, I think our time is up. I'd like to thank our panelists. I mean, it was the best and most